Hello and welcome to Business Standards Morning Show. I am Ruchika Chitravanshi and let us take a look at the stories for today. Gold has been the best performing asset class so far this year as investors have shied away from picking equities amid geopolitical uncertainty. With the Russia Ukraine situation tense and domestic economic activity gathering steam, real estate prices are also rising. So, should you invest in these asset classes? Such portfolio rejigs come with some caveats that you must keep in mind. Watch our next report to know what the analysts are advising.
Equity markets are witnessing their first meaningful correction since March 2020 amid a geopolitical crisis. If the Ukraine-Russia crisis turns out to be a prolonged affair, commodity prices will stay elevated for a long time. Clearly, this will have an impact on the domestic inflationary scenario, where there already are significant undercurrents due to increasing pass-through of higher commodity prices with improving demand in manufactured products and even services. All of this, analysts say, may move investors from equities to gold or real estate, as the two could prove to be great hedging bets against inflation. Emerging data are also backing that rationale. Consider this. Gold has emerged as the best performing asset class so far in 2022 after underperforming most risk assets last year. The yellow metal is trading above $1,900 per ounce in the international markets and is at its highest level since June 2021. On the bourses, the metal is up over 4% year to date against a 2 to 5% fall in major equity indices globally. According to Chirag Mehta, Senior Fund Manager at Quantum Asset Management, gold is set to benefit in the near term as risk-averse investors would increase exposure to it amid pullbacks in risk assets. Quote, however, in the event of this conflict getting extended, we are looking at more money printing to fund military actions, higher energy prices, and economic sanctions against Russia. All these will fan the fire of already high inflation, take a toll on slowing economic growth, and spur market volatility and risk aversion. This environment will be supportive of gold prices, but will eventually clash with the Fed's tightening cycle, which is expected to keep gold prices in check. Expectations of higher interest rates will not only spur buying in gold, but also in real estate, as investors may choose to invest in properties before the rate hike cycle kicks in, says A.K. Prabhakar, Head of Research at IDBI Capital.
Yeah, in short to medium term, gold can be a good asset class, but not more than 6 months or 9 months, because after a very long time gold has performed. So and we have interest rate hike which can happen globally, so that will have a negative impact on equity. So you will have gold outperforming, or other metals also outperforming, but these are for short to medium term, not for a long term. Rising interest rate will have an impact on real estate. So whether where you buy the real estate is also very important. If you are buying in new emerging place, then your real estate can do very good. But already something which is very developed, where the potential returns will not be great.
HDFC Securities says that the real estate upcycle is driven by rising income levels, narrowing of the rental yields, and interest rate corridor gap, market share gains by organized players, and confidence in strong economic growth. Quote, these tailwinds are favoring a real estate revival and have led to an unprecedented pickup in sales. A large share of household savings is being directed into home purchases, which could lead to disproportionate gains for strong branded players. Unquote. Anurag Group Chairman Anuj Puri told Business Standard that 80 to 85% of home buyers are end users now, With new supplies reaching pre-COVID levels in 2022, real estate prices may rise by 5 to 10%. Overall, mid-end and high-end housing segments will continue to drive demand. That said, analysts caution against tweaking portfolio construction amid event-based risks and suggest changing the exposure mildly to ride the volatility.
One should not really start looking at other asset classes just because one of them is underperforming. Basically, one should have gold, real estate, and infra exposure via REITs or InvITs, fixed income, equities in varied proportions. And in times like these, one should be tweaking the exposure rather than really overhauling it. Equities may be flattish or a bit negative over the next 12 months, but I would really see this as a great buying opportunity at lower levels. Gold hasn't performed in recent times, but one should have an exposure of about 5 to 10% of the portfolio because I expect that it could outperform in the next 12 months as we brace geopolitical uncertainty going ahead. Buying individual property as an investment for regular returns or appreciation may not really work this time, unlike what we saw 15 years back. One may buy property for self use, but excess funds in that bucket I think should be deployed in real estate instruments like REITs and InvITs, which I had mentioned earlier.
Over the long term, equities have proved to be the best performing asset class. According to a report by Credit Suisse Research Institute in collaboration with London Business School, in the past 122 years, global equities have provided an annualized real return of 5.3% in dollar terms, compared with 2% for bonds and 0.7% for bills. Thus, diversification across stocks, countries, and assets greatly improves the return-risk trade-off.
With the US, UK, and the European Union ratcheting up economic sanctions against Russia, countries like India are faced with difficult choices. That is because they depend on Moscow for a large percentage of their defense equipment. The actions could impact some of India's largest defense deals with Russia, such as the purchase of S-400 missile systems and the leasing of nuclear submarines. Our next report explores the impact of the sanctions on India's defense deals with Russia.
Between 2016 and 2020, Indian defense was the main recipient of Russian arms, accounting for 23% of the total arms import. According to the Stockholm International Peace Research Institute, 49.4% of India's arms imports between 2016 and 2020 were from Russia, and in the previous 5 years, Russia accounted for 69.6% of India's total arms imports. While India's arms imports from Russia have fallen from $3.85 billion in 2013 to $969 million in 2020, Russia continues to be India's biggest defense supplier. The defense business between the two countries is strong, with contracts worth over $15 billion in the pipeline. Several Indian defense deals are vulnerable to sanctions under a 2017 US law, including the $5.4 billion contract for 5 long-range ground-to-air S-400 Triumph missile systems, the deliveries of which began in November last year. The air defense capability of India will be significantly enhanced with the induction of this system. The US has previously objected to this purchase. Besides this, India signed a $3 billion contract in 2019 to lease a Russian nuclear attack submarine for 10 years, starting 2025. Further, the Indian Air Force wants to buy and upgrade 21 MiG-29 fighter jets lying unused in Russia for about $1 billion. It's also considering a new contract to buy 18 Sukhoi 30 MKI fighters for over $800 million. A $2 billion deal for joint production of 200 Kamov 226T light helicopters, the $4 billion purchase of 4 stealth frigates, of which 2 are to be built in India, are also underway. Defense expert and Business Standard columnist Ajay Shukla tells us what the threat of US sanctions mean for India's defense procurement deals with Russia and the options that India has.
The sanctions primarily stem from a legislation called CAATSA, countering America's adversaries through the use of sanction. That was passed by the United States when it wanted to exert pressure on Russia. And basically what it amounts to is that any country entering into arms deals or intelligence cooperation with Russia, Iran, or North Korea would face sanctions from, basically America. So India is now on the verge of signing several deals with Russia, the biggest of which is the S-400 air defense missile system. And there is an apprehension that the United States could invoke sanctions on India if India deals with Russia today. And, India has several major deals going, whether in the realm of submarines, whether in the realm of fighter aircraft, whether in the realm of cooperation in sort of overhauling equipment and so on. And each one of these things is subject to sanctions now. So India could find itself with the bulk of its weaponry and arsenal vulnerable to sanctions from America just because they are dealing with the Russians on that. Well, India can mitigate them, but the way to mitigate sanctions is not to deal with Russia. And that is what the United States wants. Theoretically, India could very well go along with that, but that doesn't sort of conform with our doctrine of strategic autonomy. The other way India could bypass sanctions is by sort of convincing the United States in talks that it has been dependent on Russian weaponry for a long time. That dependency is becoming less and less. So therefore, the United States as a major defense partner of India should not be interested in weakening India by invoking and placing sanctions on India.
Meanwhile, the center is reportedly planning to strengthen the rupee-ruble trade agreement with Russia after the US and its Western partners decided to cut off several Russian banks from the SWIFT financial messaging system that facilitates cross-border payments. Trade in the rupee-ruble account has increased many-fold since the Narendra Modi government assumed office in 2014. Western sanctions on Russian banks could also disrupt India-Russia trade, particularly fertilizers that are crucial for India's vast agriculture sector.
The Russia-Ukraine conflict has not only disturbed India's defense procurement, but also jolted global financial markets. But historically, though such instances have triggered a sharp fall in equity markets across the globe, including in India, the recovery in most cases has also been swift. Let us look at how markets have behaved during such crises earlier to assess if this time will be any different.
The past few weeks have been a trying phase for equity markets globally as they have battled several headwinds, including the recent geopolitical conflict between Russia and Ukraine that has triggered a sharp rise in the prices of commodities, especially crude oil. Analysts say the fall was a knee-jerk reaction to the Russia-Ukraine conflict, and markets were likely to witness a choppy phase before discounting this development and staging a sharp rebound. Historically, equity markets have generally overreacted to geopolitical risks. Iran's invasion of Kuwait in 1990 triggered a sharp correction in markets and oil prices doubled. The equity markets, however, returned to the peak level 4 months later. The Kargil confrontation between India and Pakistan also saw a sharp correction in the markets in mid-1999. However, markets rallied sharply after realizing that this would be a short conflict. It is very evident here that markets typically react with heightened volatility on expectations of a negative event, and even when the event unfolds. But as events unfold over time, there is a realization that the situation might get diffused. The rally in equity markets then is much sharper. This time around, however, there are multiple moving parts that investors need to track. Outcome of the state elections, Life Insurance Corporation of India IPO, which may impact available liquidity, and possible rate hikes by global central banks, especially the US Fed. Yet, analysts are hopeful that the markets will recover their lost ground and trend higher after more clarity on how these events are progressing. Sunil Singhania, founder of Abacus Asset Managers, said, "We expect the Russia-Ukraine standoff to continue in some form or other, and one should closely track the developments. However, the investment decision has to be taken based on the fundamental and economic scenario both in India and globally. The worst seems to be discounted, and though we might not have a sharp V-shaped movement, markets should start to move into positive trajectory." The markets corrected sharply in February, with the S&P BSE Sensex and the Nifty 50 indices slipping around 5% each. The fall in the mid and small caps, which have lost over 6% and 10% respectively during this period, has been sharper, ACE equity data show. While the near-term scenario will continue to be choppy, analysts said that the current correction provided an interesting entry opportunity for long-term investors. However, they must be mindful of the inflationary impact on corporate earnings, which might see some pressure over the next few quarters, they cautioned. Let's go to G. Chokkalingam, founder and chief investment officer of Economics Research, to understand if the recovery, when it happens, will be sustainable or not.
Friday trade has proved already that it is, it has the ability to bounce back. But my point is that even if it bounces back, it may not be sustainable till March end. So, because the retail investors have lost a lot of money in IPOs and e-commerce companies. And secondly, in the first 9 months, a lot of people have made a lot of money in small cap and mid cap. So there will be a lot of loss booking also to reduce the overall capital gain tax. So the selling pressure also will come. And therefore, small and mid cap could be weak till March 4th week.
On Tuesday, markets will remain closed on account of Mahashivratri. On Wednesday, however, besides tracking global developments, markets in India will also react to the GDP data announced after market hours on Monday. Stock-specific action based on news flow is likely to continue.
Following Russia's attack on Ukraine, the European Union and the US, along with its Western allies, announced measures to block selected Russian banks from the SWIFT payment system. The move is expected to have a devastating impact on the Russian economy. But what is SWIFT? Watch this report to know more about the communication system underpinning international transfers.
Among the financial sanctions imposed by Western countries on Russia is the exclusion of several Russian banks from the SWIFT payment system, which facilitates smooth and rapid money transfers across nations. Without access to SWIFT, Russian banks will find it harder to communicate with international peers, which will slow down trade and make transactions costlier. According to a US White House official, if one of the banks cut off from SWIFT wants to make a payment with a bank outside of Russia, it will likely need to use a phone or fax machine. Russian companies and individuals will find it harder to pay for imports and receive cash for exports, borrow or invest overseas. Let's learn more about SWIFT and what it does. The Society for Worldwide Interbank Financial Telecommunication, or SWIFT, is the world's leading provider of secure financial messaging services. It facilitates trillions of dollars of cross-border payments between 11,000 financial institutions in more than 200 countries. Each member has its own SWIFT code. Every day, more than 40 million financial messages are exchanged securely using the SWIFT platform. Headquartered in Belgium, SWIFT is a global member-owned cooperative that was founded in 1973 by 239 banks from 15 countries. It went live with its messaging services in 1977, replacing the telex technology that was then widely used by banks to communicate instructions related to cross-border transfers. The SWIFT Standards Group maintains several important messaging standards. The use of standardized messages and reference data ensures that information exchanged between institutions is unambiguous and machine-friendly, facilitating automation, cost reduction, and risk mitigation. Through SWIFT, banks, custodians, investment institutions, central bank, market infrastructures, and corporate clients can connect with one another to exchange structured electronic messages for common business processes like making payments or settling trades. SWIFT is a cooperative society under Belgian law and is owned and controlled by its shareholders, representing approximately 3,500 financial institutions across the world. The shareholders elect a board of 25 independent directors representing banks across the world. This board governs the company and oversees its management. The executive committee is a group of full-time employees headed by the chief executive officer. Each nation's usage of SWIFT's messaging service determines both SWIFT shareholding allocations and the number of board directors that each nation is entitled to. SWIFT is overseen by the central banks of G10 countries as well as the European Central Bank, with the National Bank of Belgium as the lead overseer. It is important to note that SWIFT is only a messaging service provider. It has no control over the underlying financial transactions that are mentioned by its financial institutional customers in their messages. While SWIFT fully complies with all applicable sanctions laws, the responsibility for ensuring that individual financial transactions comply with sanctions laws rests with the financial institutions handling them and their competent authorities. In March 2012, as international sanctions tightened against Iran over its disputed nuclear program, SWIFT was prohibited from providing financial messaging services to European Union sanctioned Iranian banks. SWIFT, since it is incorporated under Belgian law, had to comply with this regulation as confirmed by its home country government and disconnect these Iranian banks. In January 2016, many of the affected banks were removed from the sanction list by the EU and were subsequently reconnected to SWIFT. In 2014, Russia developed its own alternatives to SWIFT. It is called the System for Transfer of Financial Messages, or SPFS. But this system has struggled to establish itself in international transactions. Similarly, China launched the cross-border interbank payment system in 2015 to internationalize the use of the yuan. It allows global banks to clear cross-border yuan transactions directly onshore. CIPS still largely relies on SWIFT for cross-border financial messaging, but it has the potential to have and independently operate its own direct communication line among financial organizations. About 1,280 financial institutions from 103 countries and regions are connected to the CIPS, which processed more than $12 trillion in 2021.
That's all we have for you today. We will be back with more news and analysis. Stay tuned and thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.